Over the past 3 months, we have pushed up against the wall as it pertains to the stock market, especially the tech sector. But that doesn't mean everything hasn't been working. In fact, we've been talking a lot about this on my weekly live show, where we are seeing a bit of a rotation. A lot of investors taking profits in those tech-heavy positions and moving to other beaten-down positions. Lo and behold, we look at SCHD, and it's sitting at a 52-week high, gaining over 7% in those same 3-month period. In addition, we saw a big sell-off at the start of August, and we've seen another one here at the start of September. So are these stocks cheap all of a sudden, or is there more pain ahead? In today's video, we're going to talk about 3 positions, 3 popular positions in many portfolios. And I'm not going to make you wait around in today's video to figure out which stocks we're talking about. I'm going to let you know right now. The 3 stocks we're going to focus on today to determine whether it's time to cut the bait in them is going to be Nvidia, Microsoft, and Costco Wholesale. So before we dive deeper into each of these 3 companies, do me a huge favor to show your appreciation for these videos. Hit that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their best 10 stocks to buy right now, completely free. All right, let's jump back into today's video, taking a look at these 3 high-flying stocks. These are 3 very popular stocks that you can find in many positions out there. Again, Nvidia, Microsoft, and Costco. To tell you just the performance that these companies have seen in the past few years, let me show you these charts here. Looking at this chart, you can see that since the start of 2023, here's the returns for those 3 companies. Nvidia, an incredible 600% return. Costco in second at 92% return. And Microsoft gaining nearly 70% over those 3 years. Those are incredible returns over just an 18-month period. However, the past 2.5 months have not been all that great. As you can see, those same exact stocks has Nvidia down 22%, Microsoft down nearly 10%, and Costco just kind of fluttering there, up only 2%. Is it time to buy or sell? Let's take a look. And let's begin first by taking a look at Nvidia, stock ticker NVDA. In terms of size, Nvidia is one of the 3 largest companies here in the US, and for that matter, in the world. However, the company trades more closely aligned as if it was a mid-cap or even a small cap. There's not a lot of large companies in the trillions of dollars with market cap that trade and swing 10% moves as often as Nvidia does. However, it did once hold that $3 trillion market cap, but with those losses that it's seen in the past few months, it is now under that $3 trillion threshold and currently has a market cap of $2.5 trillion. I'm not going to say just 2.5 because it's still a very large company. And over the past 12 months, the stock is up nearly 120%. But as I mentioned, the past 2.5 months, it hasn't been great, down nearly 25%. Now again, over those past 18 months, this has been by far one of the best stocks to own in your portfolio. Up 600% in that short of a time span is just simply incredible. And all of this has to do with the boom that we've seen in AI. And to me, I still believe that AI is in its early stages and it could have plenty of runway. So there's no real concern from that vantage point there. However, that doesn't mean we just blatantly buy stocks. It's just like real estate. Over decades and decades, we have seen the price of real estate appreciate over time. But we don't go buy a home without even looking and comparing comps, looking at valuation. At some point, valuation has to matter. So with that being said, now that the stock has pulled back nearly 25% in a short period of time, let's take a look and see, is it worth buying today? Here you can see analysts' EPS estimates for the next few years. Obviously, growth has been magical the past few years, but that makes comps moving forward difficult to keep those growth figures. But the average annual growth rate still sits near 30% each of the next 2 years. Using the 2025 estimates of $3.99, this has shares currently trading at a forward PE multiple of just 25.7 times, which is not all that bad. This gives the stock a PEG ratio of 0.89. using a 2-year average growth rate, which provides plenty of value for investors. Looking at another metric, EV to EBITDA, shares trade at 42.3 times, which is the lowest shares have traded at since 2018. Now let's see what the technicals can tell us. Looking here, we can see that the next line of defense for the stock is going to be around $95 per share, not too far from where we are currently, as this was an area of resistance for the stock prior. If that $95 threshold doesn't hold, we could see a good amount of selling pressures, as things then move towards the next support line down at $75 per share. This does not mean the stock will fall that low, just pointing out some key levels from a technical side of things. So with all of this information, what should we do with the stock? Well, it really is going to come down to whether you own any positions in NVIDIA or you don't own any positions, because in terms of valuation right here, they're not all that terrible. From a PE perspective, from an EV to EBITDA, we looked at the PEG ratio. They're not all that bad. Obviously, growth is slowing just because the comps are that much more difficult when you're growing at 200 and 400% year over year. That's not something that is sustainable. But the technicals do give me some worry, as we're kind of at a crossroads right now. So the way I'm playing it, and again, I have a position in NVIDIA right now, a large position in NVIDIA, not as large as it once was, but still a sizable position. So the way I'm approaching it is by using options, and I'm selling a cash secured put closer to that $90 level. So based on that, shares would need to fall roughly another 10% from where they're at right now. And if I put that number into my valuation tool, that will show an even more intriguing valuation. So it's a way for me to be patient and generate cash flow at the same time. So in conclusion, this is a stock that I currently hold and I'm not looking to buy right now. Now let's move on to the second stock on our list, which is going to be Microsoft, stock ticker MSFT. Now Microsoft is even larger than NVIDIA. They too once had a $3 trillion market cap, but with the share losses we've seen in the recent months, it is now also below that $3 trillion threshold, meaning only one company right now in all of the US has a $3 trillion market cap, and that is Apple. Microsoft is a fantastic company, another one heavily involved in AI, but instead of creating their own AI, they chose another route by investing in OpenAI, which is another leader in that space. OpenAI was actually recently valued at over $100 billion, meaning Microsoft has essentially 4x their investment thus far. Microsoft currently has a market cap of $2.98 trillion, right there on the doorstep of that $3 trillion mark. Over the past 12 months, shares are up 21%, but over the past 2.5 months, down roughly 10%. So yeah, Microsoft is yet another player when it comes to AI. But they're also a very diversified business. And that's one thing I love about Microsoft. They have this AI component that continues to grow and will hopefully contribute more revenues down the line. But they also are a major cloud player, one of the largest cloud providers in the US or around the globe for that matter. They're involved in gaming. They have hardware. How about subscriptions, social media, and the list goes on. In the company's most recent earnings report, they beat on both revenue and earnings, top and bottom, with revenue growing 15% and earnings per share nearly 10%. Now, not nearly as fast as NVIDIA, but still rather fast for the size of the company. Microsoft is yet another company that still remains, even at its size, with a bright future. And the reason being is they generate so much money in free cash flow. And what free cash flow allows them to do is to invest in the next big thing, to generate future growth for decades ahead. Here's a look at just how much free cash flow has grown for Microsoft over the past decade. And looking out over the past 12 months, they have generated nearly $75 billion in free cash flow, an all-time high for the company. So the results are great. Management is fantastic, but does valuation make sense? Taking a look here at earnings growth, analysts are expecting 15% growth per year on average over the next 3 years, still growing at a very solid clip. Using the 2025 estimates, this gives shares of Microsoft a forward PE multiple of 30.5 times and a PEG ratio of 2. Both of them not that intriguing. The PE is in line with their 5-year average, providing no discount at all, and I like to buy things on sale, not at full price. Since we talked about how much free cash flow the company is generating, let's also take a look at the free cash flow metric, which currently sits at 25.6 times. Again, exactly in line with the company's 5-year average. Every metric we look at is indicating shares of Microsoft are just trading at fair value. And again, I like to buy things that are on sale. Let's take a look at the technicals. Taking a look here at the charts, you could see that $388 is really that next line of defense when it comes to Microsoft before falling down further to that $365 level. At $365, shares would trade at a PE of 27.7 times, looking much more intriguing. So when it comes to Microsoft, there's not a ton to like in terms of valuation. Technicals give me plenty of concern as well. So although I already own a sizable position, I'm not in any rush to gain more shares in my portfolio. Now let's move on to the third stock on our list, which is going to be Costco Wholesale, stock ticker COST. Costco is a classic example of a fantastic company at a not so fantastic stock price. Quite frankly, buying this stock right here at these levels makes very little sense to me. It is so important that when it comes to investing that you are able to differentiate a company from a stock price. You can love a company doesn't necessarily mean you need to love its valuation. And these are things that we talk about in my 6-week Investing Accelerator program, where we have one-on-one programs as well as our academy, which is a group coaching program. And our next cohort actually kicks off this coming Tuesday, September 10th at 8 p.m. Eastern Time. We go through my entire valuation checklist, understanding how to both analyze companies, value companies to determine whether they are a buy, sell, or hold, to determine whether they are a good fit for your portfolio based on your strategy. So if you're looking on the sidelines to become a better portfolio manager, check out that 6-week program as we have a few discounted slots still available. Again, we start next Tuesday, September 10th at 8 p.m. Eastern Time. And the great thing about it is you can also do it at your own pace, just in case you can't make the live sessions every Tuesday. So with that being said, now let's get back to Costco, which again, that's where my family does the majority of our grocery shopping every single month. In terms of size, Costco currently has a market cap of $389 billion. Over the past 12 months, shares are up 60%, but over the past 2.5 months, shares are up only 2%. Costco is historically a company that trades at a huge premium to the market, and it doesn't really have that much in terms of growth. It does have a great management team, and it also provides consistency and a $1.50 hot dog, which is probably going to go down as one of the best marketing ploys that's out there today. But at some point, valuation has to matter, and that's my issue with Costco. For starters, if I were to ask you, over the next 3 years starting right now, if you could only choose one stock for your portfolio, would it be Nvidia or would it be Costco? Let me know down in the comment section below, but I would go on to guess that the majority of you are probably going to choose Nvidia. And I think that makes a lot of sense because if you're looking at it from a PE valuation metric, Costco already trades at a premium valuation, but it has a valuation that is even larger than that of Nvidia with only a third of the growth rate. Let me show you. Analysts are expecting EPS of $17.80 next year with an average of 10% EPS growth rate each of the next 2 years. A third of what Nvidia is doing again. Using next year's estimates, shares of Costco currently trade at an absurd 49.3 times. Nearly 50 times for a company growing earnings at 10%? No thanks. I understand that it is a great business model and they have consistency. I understand they have great products. But that is an absurd valuation. And it is also a very low margin business. This is a company that operates with an operating margin of just 3.5%. So with that all being said, a 50 times multiple, a huge premium, that compares to their 5-year average, which I believe is already inflated, their 5-year average of 38.8 times. So that's already high, but Costco is so far beyond their 5-year average as well. Come on, people. Valuation matters. So let's turn our attention now and look at a different angle. Let's look at free cash flow, where the company currently trades with a multiple of 32.5 times. Again, well above their 5-year average of 23.7 times. Every metric you look at flashes sell. If I own the stock today, which I don't, this is one I would definitely be trimming from my portfolio. Valuation matters. Lack of growth, a 50 times multiple just doesn't make sense for me in my portfolio, which is why I would be trimming the stock at these levels right here and waiting for a much better entry point moving forward. So with that, we just looked at 3 popular stocks: Nvidia, Microsoft, and Costco. Only one of them would I be aggressively selling right now. Nvidia and Microsoft, not rushing to buy right now. Nvidia's valuation looks rather intriguing. Microsoft, pretty much fairly valued, but I'm going to be patient with both of those there. And again, if you're looking to step your game up and really become a true portfolio manager for your own personal portfolio, then again, consider my 6-week Investing Accelerator Academy. We will be launching our next cohort Tuesday, September 10th, and we still have a few slots at a discounted rate, and you can check out the link down in the description below. If you enjoyed today's video, again, do me a favor, click that like button if you haven't done so yet, subscribe to the channel, and we'll see you in the next one. Take care.